Hello and welcome to this week's installment of Nucleus Investment Insights. My name's Jayden and I'm filling in as the temporary host of the program. But more importantly, I'm joined by two members of Nucleus Wealth's investment team, our Head of Investments, Damien Klassen. Good afternoon, Damien. You
Have we
muted
lost?
there, Damien.
No, sorry. Hi, guys.
No worries. And our Chief Strategist, David Llewellyn Smith. G'day, David.
Hi, Jayden.
So, our topic of the day, will the earnings boom continue? On the agenda, we've got an economic slowdown, a top-down view of US earnings, regional earnings, sector earnings, individual stocks, and as always, our investment outlook. As always, of course, before we get started, a quick reminder that if you enjoy our content and haven't already, please consider subscribing to us on YouTube and click the notification bell to be notified of when we go live or have some new content to watch. Alternatively, you can follow us on your preferred podcast platform. For those listening in live, feel free, as always, to drop your questions into the YouTube live stream chat as we go, and we'll endeavor to answer them for you. So, guys, I thought we might start with a bit of background on the current earnings boom.
Yeah, sure. Do you want to jump into, I guess, economic slowdown, David? That's probably, and I guess what we're actually, why don't I set the scene as well, is that where we're coming to from this is last reporting season, or the last 2 or 3 reporting seasons have just been cracking reporting seasons, and this is particularly in the US and global markets we're talking about, and we're about a third of the way through the current reporting season, maybe a little bit less, and it's just worth catching up on what's happening in terms of numbers before we sort of get too far into it to sort of see where earnings look like they're going. So with that, Dave, I might hand over to you on sort of what's happening in the broader economy first.
Yeah, sure. So we've obviously been through this pretty extraordinary stimulus snapback boom after all the COVID lockdowns in the last 18 months. Initially fired off by China with its big stimulus. It was really a bit of a super stimulus out of China, although it was relatively short. And then followed on by particularly the US, where we saw some really big fiscal spending, as well as lots of monetary stimulus. And the simple fact of the matter is that most of that stimulus is now winding down as the pandemic eases, or at least becomes endemic, and people start to live with COVID. And so it's not all bad news in that sense, because of course the stimulus is winding down because the economies have been opening up, and so there's been a handoff to the private sector, and so far that has delivered a real out of the box profits boom that we've been riding all year. But as we noted many times with this cycle, it's quite peculiar in terms of amplitude and speed, by which I mean it's more volatile than a normal business cycle and moving more quickly than a normal business cycle. So we find ourselves only, a little over 18 months, 20 months into this cycle, and really the early cycle recovery is over. That's the period where you come out of your big crash, and there's a whole lot of really easy growth, a whole lot of easy profits growth, because everyone shredded their costs, and then you get stimulus, and then a big pent-up demand hits that, and so everyone's got fat margins, and you get this tearaway profits boom. And this is very typical of any recession, but this time it's been even bigger, swifter, but also coming off just as fast, or at least it is in economic terms. And so we're moving very quickly into sort of mid-cycle slowdown, which is also very typical. It's just that it's happening more quickly, and there are some peculiar elements of this stimulus removal that mean that it's happening very sharply and quickly, and I'll go run through those quickly. So China obviously used this stimulus boom in the West or in developed economies, which delivered it a huge exports lift. They're using that to deleverage their property sector, and so that has slowed the Chinese growth considerably because its construction sector, both in property and infrastructure, is falling at a phenomenal rate. And it's got, other stuff going on with a lot of investment into higher value add manufacturing and services. And so, employment's still solid, even though there's this structural adjustment. But in fact, despite construction coming off and, kind of loosening economic resources, the exports boom was so big that it created some supply side constraints where they simply couldn't meet the demand. And so they've been, there's been some cuts in output on that front to slow growth a little. And we've had this crazy, commodity boom as well, which most of which was really very idiosyncratic, not structural, including the recent energy run-up, which has also forced China to curtail some output and slow it down as well. And then finally, we've got ongoing COVID shutdowns still. I mean, mostly there aren't a lot of lockdowns these days, except in China, but we still do have them. Obviously, with the Delta outbreak in Q3, which slows things down for services, and China is again shutting down quite a few million people today in its zero COVID strategy. So those things have all slowed China very quickly. And there's a chart here on the page. You can see how quickly this year. In fact, it's hasn't grown much at all this year.
So sorry, this is the
that's the bottom chart,
yep.
Which is China's quarterly growth. So at this stage this year, it will have only grown like 1.6% over the first 3 quarters. And you've got to add the fourth quarter to that, of course, but most people don't have anything like these lower numbers in their outlooks. So, most economists, most houses are above 5% for this year, and then roughly the same for next year. And we're already way below that kind of trend line in China, and we're not going to come up in time to meet it, certainly to meet it this year, probably not next year either. In fact, I argue. So, we've got this mid-cycle Chinese slowdown for starters. Now, that's based on their various attempts to structurally adjust their economy, by and large. At the same time, the US, has been supporting, quite rightly, the economy very strongly with fiscal stimulus last year, to the tune, I think, of 6 or 8 billion in giveaways to households through a number of packages, both first through Trump and then through the Biden administrations. And those are starting to roll off in year-on-year terms. So that's automatically, spending that won't be in the economy this year, and so that detracts from growth. Now, again, a lot of those giveaways to households increased household savings, and so they will be spent. And so it's not like it's all one-way traffic here. The private sector opening up offsets this, but it nonetheless is has started to cause and will cause much more very severe slowing in the US. We can see this in the latest Fed GDP Now chart, which I've got in here, which has got the US economy also growing currently at 0.2% in this quarter. So we're talking, economies that have gone from 8% per annum to, under 1 in a quarter, in effect, or a quarter or two. And that is a very, very sharp slowdown. And on top of that, that gives you basically, the major two of the major importers in the world, and then you have the largest economy in the world in Europe being very much an export-driven economy, and so it's going to slow on the back of this as well. And then you have EMs, emerging markets, which are sort of similarly structured, which are also going to get hit by this slowdown. So you have what was a global boom coming off very, very quickly, and there are sort of trends within that, booms and busts as well, that kind of net out to some growth, but not a lot of growth. So, for instance, we still think that the huge consumption boom in the US that's driven Chinese exports will steadily just peter out as those private savings, are spent, or pent-up demand is exhausted.
And I guess just as importantly, it'll switch from manufacturing sort of goods into services.
Absolutely,
Well,
and then
so
a lot of that
manufacturing
spend.
will cop a lot more.
Yes, exactly. And so the goods pulse in particular will diminish, and then there'll be a handoff to services slowly but surely, as we all become accustomed to endemic COVID. And what comes with that, we think, is a commodities crash, because it's that demand for hard goods that sucks in the raw materials that has driven so many of the commodities booms and busts that we've seen over the last year. And then that in turn really hits emerging markets again if you get that kind of dynamic in play. And so there's no one really in the global economy, as this slowdown takes place, that can really accelerate and offset it, and drag the global economy through what is quite a sharp slowing. Now, don't get me wrong, this is not a new recession. It's not, excuse me, it's not going to be a crash, but it is a severe slowing. And some of these major economies are operating almost at stall speed. China and the US together, both. But at the same time, as you come out of some of the constraints we've seen on the supply side, there'll be a bit of an acceleration there as well. But net, it's a sharp slowdown. And of course, that makes it more difficult for companies to grow profits, is what the point of that little spiel is all about. At which point I'll hand over to you, Damo, to have a look at how those profits are tracking.
Yeah, sure. So what I might do is I'll run relatively quickly through some of the bigger picture things, and then maybe we can sort of start talking about some of the more specifics about sectors at the end. Is probably the more interesting part. But just to sort of set the scene, I've got a slide here of the net earnings revisions that have been occurring, and this is sort of quite a long-term one over the last sort of 30 or 40 years. And you can see that the current sort of cycle upgrades in terms of analysts sort of upgrading their earnings is getting long in the tooth. It's not to say it can't go for a lot longer, but it's certainly been an extremely high. There's been a lot of upgrades, and it's lasted for quite a while so far. So wouldn't, but it is still quite positive. It's come off its peaks, but it's still from looking at the 12-month forward earnings, it still looks very good. The next chart sort of digs a little bit more into where you get that from. So there's a red line on this chart sort of that's rising over time, and that's showing the what's called the forward earnings. So whereas the blue lines show each of the individual years, and what you see within that is analysts sort of upgrade their forecasts over the last few years for individual years, and then we have this. Then you got the sort of the natural growth rate, so you get like a little bit more of 2021 and a little bit less of 2020, and then as you roll forward, you start getting a little bit more of 2022 and a little bit less of 2021, and so that's why the red line sort of rises much faster than the blue ones. But you've on this chart, you can sort of see there's sort of two sort of upward humps that you got. Two big upward humps was the second quarter earnings, and it was actually the first quarter earnings. At the end of the first quarter, start of the second quarter, you got the first quarter earnings coming through, and then you got the second quarter earnings coming through. And in both of those, you can see that all those earnings sort of really took this extra leg up, where they flowed through with you saw these upgrades to earnings, and that's sort of come to come to a bit of a halt, and we're into the the early stages of this reporting season, and we really haven't seen those upgrades continue. So we're certainly still seeing the 12-month forward numbers rising, but that's just sort of a natural course of a little bit more of the next year. What we haven't seen is those forecasts, and so the next chart I've got shows that over a sort of longer time frame. So that the 2021 and 2022 numbers are just those tiny little sort of flattening parts at the end of the lines. But you can also see that the natural tendency for earnings forecasts, certainly over the last decade, has been for downgrades. So in 2018, 2019, you got a one-off big jump from the Trump tax cuts, but sort of post that, you went back to that same trend of earnings forecasts sort of start and then just lead into disappointment as they sort of gradually get worked down to the actual levels. And so holding steady is a good thing, I suppose, in terms of in terms of the traditional way forecasts go. So just because earnings look like they have stalled and you're not seeing that extra growth, that's not necessarily a bad thing as of yet. So sort of, again, not being overly negative, but certainly recognizing that the really bullish and really strong upgrade cycles that we've seen over the last couple of reporting seasons just haven't been there. And finally, that sort of goes into this growth figure where, I like to think that, well, not like to think, it sort of, it appears to me that analysts generally come in with forecasts around about 10 to 15% for the next year. And then as that year gets closer and closer, those earnings forecasts go one way or the other. And you can sort of see that with this line, where this is the same lines, but just showing a growth rate. And so what tends to happen is you start at that initial figure and then go either way. We can see 2022, it's really still at just that 10% level at the moment for growth. So it could easily go either direction from here. But the recent trend has been that for less growth, but that's been more that's we've seen such strong growth in 2021 that sort of increase in the base, and 2022's forecasts aren't going anywhere, which means the growth rate's been declining.
Some of that will be market recognition of slowing economies too.
Yes, yeah, some of it will be. But again, I think keep in mind that the first quarter and the first year of forecasts, while it's notionally an analyst forecast, it's really a company forecast. So companies will they'll guide analysts back to what they think the right numbers are. And you do get some echo chamber effects within that, where if you have analysts all telling companies how great things are, and how good the future is going to be from a strategic point of view, and Wall Street's talking everything up, is that then companies will echo that back to Wall Street, which will then echo it back to companies again. And you sometimes get extremes on either side, on the upside and the downside, because of that. So I guess we certainly take the forecasts with they're a very good tool in terms of giving us a pretty up-to-date picture, but recognizing that certainly the longer term ones can get sort of considerably out of whack. If we then just look at some of the big regional, there's not a lot of difference between the regions. There's the third quarter numbers are all, there's a lot of base effects going on, so I won't sort of focus on those. The growth's very strong, but it's it's a bit hard to tell what's really going on with those numbers, but we're certainly getting a lot of that. We have got a reasonable amount of earnings surprise in the third quarter, so sort of 5 or 6% in Europe and the US, and almost 10% sort of earnings surprise in Asia. Having said that, when you jump to the next screen, though, this is really showing what's going on at the forecast level. So the 12-month forward earnings are up a little bit, but the 2022 forecasts are pretty much unchanged from where they were a month sort of prior to companies reporting. So it's a much more normal distribution we're seeing. Whereas last time we were seeing even at the 10th percentile, there was some rises in earnings, and definitely the 20. So basically the worst 10% of stocks were still upgrading earnings, whereas now it's a bit more normal in that you've got some stocks downgrading, some stocks are upgrading, and the average is roughly about 0. So that's that one. I'll jump then into the sectors. When you jump into the sectors, a lot of this is energy. So energy's been particularly strong, as we've seen, and we spoke, spent a long time last week going through the energy price rises, but there hasn't been much earnings surprise in that sector, but there's certainly been upgrades in terms of earnings. Most of the other sectors are relatively flat. And then I'll get then into some of the sector stuff, which is where I wanted to sort of talk a bit more around this with David. So I pulled out a couple of different sectors that are sort of highlighting what's going on, and and some of the individual stocks within those sectors. So I've sorted each one of these four by their by the price rises. So one of them was the luxury goods sector. So I might start with that. It's probably the least exciting moves, but relatively uniform across the board there, in that we've spoken before about the whole inequality side, and while inequality and demand for material goods is rising, then this sector can do quite well, and we're seeing that relatively across the board we've seen price rises from them. Certainly the messages coming back in terms of earnings has been positive, and you've had some reasonable upgrades through through most of the companies within that sector. So do those ones. Then I might jump to probably the most interesting and most contentious, some of these transport and transport utilities. So
And that's in the top left there, isn't it, Damien?
Yeah, so transport at the top left, and the bottom left is the transport utilities. And so in particular, the transport utilities are mainly the railroads. And you can see that their price rises over the last month have sort of been 10 to 15%, but not much on the earnings. Actually, in some of the earnings, is even Kansas City Southern had some reasonable downgrades to earnings, as in Canadian Pacific. So, and I think the commentary around these transport ones has sort of gone from, okay, there's blockages within the systems, and so at last reporting, look, there's blockages, it's slowing things down. It means we're getting the companies there are getting price rises through as people are trying to hurry their better value goods, the higher value goods along. But what's happened though is that they have the commentary is starting to sound more like it's going to last for much longer. And I guess that the sort of the trite way of discussing this is a bit like the inflation part, which is like everyone at the start was like, yes, inflation will be transitory and probably won't last that long. And then once people have seen the inflation, then they're suddenly saying, actually, you know what, now we're in for the next 5 years or 10 years of high inflation, and it's sort of a bit similar to this in terms of, look, there's traffic jams and goods are all blocked up, and there's all these ships off the port of LA, and it's gone from, it'll clear, but we're not quite sure when, but it'll probably be relatively soon, to this thing's going to last for a long, long time. And so I guess that's where I want to sort of toss back over to you, Dave, and get your thoughts on how transient or not, I guess, these transport problems are within the system now. Overview of you.
Well, I see it as horse shit, basically. I mean, it's very difficult to know when it ends. I'm not going to argue that, but I really just see these transport firms, as you say, there's a shift in rhetoric and attitude, which is really just gaming the environment. So, the bottom line is, yes, we've got various congestion points, particularly between the US and China, because we've had this huge stimulus, consumption stimulus, and exports from China. So fine, that's, while it lasts, is quite difficult. And every time they sort of fix one pressure point, another one pops up. And so it has proved to be a little more persistent than at first thought, but we're really only talking a quarter or so at this stage. However, if you look forward, I mean, two things, I guess. One, for it to persist, the extreme demand has to persist. And it has already been falling away in terms of growth rate. Some of that is the base effect, but it's also the fact that the stimulus is coming out, and so household incomes are falling away in the US, and it's a more reasonable expectation for that to continue than to not, I think. Even though there have been big wealth effects and stuff in the US as well, I don't think that's enough to offset the income drain. And the thing is, the income tends to be more at the marginal propensity to consume households, whereas the wealth is in the more concentrated hands. So it's highly questionable that level of demand will persist. The volumes will fall. And then, of course, we have the handoff to services as well, because as life normalizes, then that makes perfect sense too. So I think on the demand side, we will see it diminish in volume terms, not crash, but diminish. And you're already seeing that in the US-China trade routes, where containerized throughput in China has begun to fall. Shipping rates between the two have fallen a lot. Container rental rates have fallen a lot. Partly this is because of, the supply constraints couldn't actually keep up with demand. So it's not necessarily all about the fact that demand is going to fall away. But I think as well, if you look at where we are in the annual cycle, we're coming into Christmas, so we're obviously got elevated goods shipments in the annual inventory cycle, and I just think demand's going to come off going into the new year and give some breathing space. And so that's point one. Will demand remain so elevated? I don't think so. And point two is, nobody's just sitting around watching this, gawking at it with their mouths open and doing nothing. As we've discussed many times already, there are billions of little nips and tucks going on the supply side to try and fix this all day, every day. Everything from, things like software innovation to packing more boxes into containers, finding efficiencies in, right across the supply chain. Now, they haven't been enough yet. And one this week, I think, was a pretty funny one in the LA ports. I believe they have a rule there. You can't stack containers more than 2 high, which is a NIMBY rule, right? But I mean, I drive past the Melbourne port and they're about 25 high down there, and they've temporarily suspended that rule. So they can go now 5 high, I think, which obviously expands capacity by 150% in the port. Now, there are other constraints coming out of the port in trucking and rail and what have you, but this is the thing. They're doing bits and pieces all over the place, and you solve one problem, another one rises. But each time you solve a problem, once you clear the backlog, you'll have a much more efficient system than the one you went in with. And this is where the traffic jam analogy becomes really good, because when you go from a traffic jam on a freeway, that is got a tailback and everyone's doing 10 kilometers an hour, and the speed limit's 110. When it clears, they don't go to 20 kilometers an hour; they go to 110. And so suddenly, what was congestion becomes an absolute, well-oiled machine that just throws stuff through like you wouldn't believe. And at that point, your prices, you found all these efficiencies, and your prices crater and probably go back to lower than they were before you started. So you got this one demand side factor and this other supply side factor, and I just think that there are a lot of things kind of converging on the post-Christmas period that mean it's possible we'll start to see this thing really unwind. One being Christmas demand, two being the two energy crises in China and Europe, both kind of resolving through winter or coming to a head and then resolving in winter. Fed tightening, this fiscal cliff in the US, the Chinese property smash. These things are all kind of decelerating into the new year of 2022. And so, I just think a lot of the gaming that's going on in some of these areas is going to get more difficult. They'll find themselves suddenly having to compete again, and we're going to see a lot of price falls coming in the new year. So, that's not necessarily a bad thing. Well, it's a good thing, like for the economy and for everybody, quite frankly. And even, but it is a pretty typical kind of mid-cycle slowdown, exaggerated mid-cycle slowdown, where you've had this incredible pump up in prices and margins, and that's all just going to compress coming into this slowdown. And then I'm not at all saying that we're going into a recession. In fact, what would be ideal here, and is actually shaping up, once you kind of um, look beyond, perhaps 2022, let's say getting into 2023, if you do get all of these deflating bubbles, because I see them as bubbles, I don't think they're going to last. Then all these costs are going to come out of the system, but then we'll still have relatively tight labour markets, and we'll have this new services uplift in economies, and so what I look forward to is some reasonably strong wages growth. Now, people might say, well, that'll just be another round of inflation, but that's good inflation. That's what we want to see, is some decent wages growth. And if that's coupled with all of this supply side deflation, then you're actually going to get a terrific Goldilocks scenario in which prices are falling and wages are rising and real living standards are going forward at a great clip. And that is actually a pretty good scenario for profits as well, because a lot of those, some of those little gamed profits through the supply side squeeze will be kept. Some of the efficiency gains and productivity gains through the squeeze will be kept. And yes, some will be lost to labour, but there'll be stronger top line growth from labour squeezing a little bit of that juice for themselves. And so demand lifts. And so coming out of this into 2023, I think it actually looks pretty good for profits. And you obviously have to look very carefully at what sectors, etc., you want to go into. But it just looks to me like the mid-cycle scenario looks quite gloomy for a year or so, and then it resets, and we can kind of, build into an expansion phase of the economy and profits. So, when we ask a question, at least from the top-down point of view, from the macro point of view, there is a difficult period, I think, for profits growth ahead, but it's sort of one we need to go through to refresh the cycle, and then we can kind of rebuild again.
But part of this is you really want to find the companies that can hold the price rises, because I sort of see it going two ways in terms of there'll be companies out there who have gone, you know what, you can't get the widget that I'm selling, and so therefore I'm putting the price up by 20%. And then when it clears, they'll bring their price back to 15, and they'll hold on to that, most of that gain, and their profits will be good because of it.
Absolutely.
But then there'll be another class of companies who jack it up to 20%, and then it clears, and then the manufacturing starts to ease as people start buying more services, and then they'll be sitting there going, just a minute, I better bring my prices down to try and sell. I've actually got a big backlog, and I placed all these extra orders to try and, while there was stuff on, because I could sell the things. So they've got all this inventory they've got to try and clear, and then they start chasing the price down, and they're the ones where we'll probably end up with lower prices and worse margins, in that they're trying to shove. They're trying to get rid of their volumes by lowering prices. And so, pricing power is going to be really important. There's going to be some companies over this recent period who look like they have pricing power, but they don't. It's just that there's been a shortage throughout the system.
Yes, absolutely. There's a lot of those, I think. I guess that's our job, is to sort which ones will be able to hold and which ones will slip back.
The other one I just wanted to highlight then as well, just the FANGs haven't all reported yet, but a decent chunk of some of these growth stocks have. And so in particular, Snap came through and Twitter both came through with some revenue misses, and saw some very hefty share price falls on the back of that. And a lot of this is around this whole thought that if you're a growth stock and you're on this trajectory of growing it at 20% per annum, and people are pricing that in, and then you slow down to only growing at 15% per annum, it can make a big difference later on in years. And if people start, when investors think stocks have gone X growth, they really start to penalize some companies. And so we saw that with Snap, Twitter to a lesser extent. Facebook was down on a lot of issues in terms of there was a little bit on the earnings side, but it was mostly regulatory issues, I think, there. And then the rest of the sectors, been up reasonable. Tesla's had a cracker, and we're seeing earnings coming through from those guys, earnings upgrades again at reasonable rates.
It's not on here, but do you happen to know how Netflix did?
Let me pull that one up.
Pretty good, I think.
Yeah, off the top of my head, I don't have it there, but while I'm finding that, do you want to maybe hit up some of the viewer questions?
Yeah, absolutely. So Dave, one for you from
Yep.
Miranda Marcelo, or Marcelo Miranda. What do you foresee as being the earnings in Q4 for mining producers such as Vale or Rio, so some of the bigger Brazilian mining producers?
Well, I mean, the context for iron ore, which is all that really matters to both, iron ore is 80. Or was that BHP? I can't remember. Well, it's so much that it's all that matters. And Vale is very much the same. So the context for iron ore is very gloomy. As mentioned earlier in the program, the Chinese construction collapse, and it is a collapse that we're looking at. It's huge. Is sucking enormous quantities of iron ore demand away, and that's been protected in the short term by some of the power crunch that we've seen, which has forced all of its electric arc furnaces offline, or a lot of them, about 60% of them, and they use scrap, not iron ore, and that's about 120 million tonnes worth of steel, or about 200 million tonnes of iron ore demand. But that's all been driven by this very high coal price, and the coal price is now collapsing, like absolutely collapsing. It's spectacular to watch. So that means that electric arc furnace stuff will come back online, because it's being pushed very hard by Beijing as an environmental transformation from using traditional blast furnace steel to electric arc. And when they do, that's another 200 million tonnes of iron ore demand that just disappears, poof, over the next couple of months. So unless China stimulates meaningfully, it's doing things around the margin, but it's incremental and it's not enough. Meaningfully, which probably means at this stage removing 3 red lines, the policy that's constraining Chinese developers, and cutting interest rates. I think those two are probably a prerequisite before getting any kind of meaningful uptick in Chinese construction. There's some hope on infrastructure, but not even that is really troubled because it's so attached to property. Then, the outlook for iron ore demand is just so weak that it's overwhelming. And so, if we have Q4 is traditionally a very strong quarter for iron ore and the iron ore price. In fact, it goes up nearly every year. But when we get these circumstances, as we did in 2015, it can just keep falling, as it did that year and created right through New Year. And I think that's odds on again for this year. So you asked me about Q4. Well, it's hard to say. It's seasonally strong, but the top-down setup's extremely weak and potentially structurally weak. And therefore, looking out to Q2 or what would be Q3 on the financial year, or Q1 calendar year 2022. Same story, and then you're into weak seasonal periods in Q2 next year, 22. It's just a very, very difficult circumstance for the entire ferrous complex. Coking coal is just as bad, and I think thermal coal is going to come off like a rocket as well and just go back to where it was at the beginning of this year really fast. And so all of those miners are in trouble, I think, big trouble, and their earnings, yeah, because I mean we're talking before China meaningfully stimulates, we are talking hundreds of millions of tons of iron ore surplus in the global economy.
It is worth saying though. So we've had a month of Q4 already, and while earnings are going to be falling quite significantly, they're still going to make good profits. Like they're still at current levels, they're making bucket loads of money. It's just going to be falling from what it was.
Like that. I mean, I actually, it does look odds on to me like we're going to threaten the lows we saw in early 2016 at some point over the next 3 to 6 months in iron ore. At which point, profits really will get annihilated once we get down there. But even there, even at $38, Vale is making okay money, and the Pilbara guys are making great money. Like it's just
reasonable money.
Well, I mean, it's still almost 100% markup on their costs. So it's not great in terms of what they've been doing for many years, obviously, but it's still good money. Like there's still great margins and businesses at that point, which should tell you how far this can fall, because the lion's share of iron ore output is very, very cheap. So if we've got such a large amount of marginal supply that needs to come out, then the price can really get hammered. So I wouldn't go near the miners. I mean, that's not advice, but it's a very bad setup for mining equities, and the iron ore mining equities.
Yep. The other, actually, Jayden, let's hit that other question as well, because this is actually basically leading us into what we want to just do a quick 5-minute sort of wrap up on some of the bond things, but.
Yeah, for sure. So we've got another question here. Do you think that the taper or increase of interest could impact these earnings that we've spoke about today? Will inflation or the lack of inflation be a contributing factor for these earnings?
Yeah, definitely. I mean, taper's more about price multiple than the earnings themselves. I mean, the QE really affects asset prices rather than the real economy particularly. I mean, the two are obviously linked, but it tends to inflate equity multiples. So as the taper comes out and we lose all that liquidity, then yes, I think multiple contraction is part of this whole sort of mid-cycle slowdown and stock shakeout thesis. In terms of inflation and deflation, I mean, the market's just red hot on inflation at the moment. It's now hit Australia, where today we're seeing an absolute spectacular belting for the bond market, because basically the RBA has allowed its yield curve control to get obliterated.
Yeah. So just to put that in context as well, so the RBA said the 3-year they were going to hold at 10 basis points, and it's now 110. So it's 11 times higher than their target.
So I mean that I mean, it's pretty laughable. It's, to my mind, because the notion that we're going to get 4 rate hikes or whatever in the next however many years, 4 to 6 rate hikes, it just makes me laugh. I mean, aside from anything else, if we do get this commodity deflation next year, that's going to hit Australia particularly hard, and then the entire structure of economy with immigration, etc., makes inflation very difficult. So I mean, it's not impossible, but it's very unlikely. But for the time being, inflation.
But to make your money on that at the moment, you need you probably need six or seven rate rises from here.
Yeah, which
So-
would crater the Australian economy. I have no doubt whatsoever. I mean, we have just capitalised, probably 1.9% fixed rates into the housing market, and you're gonna have all those people roll off into 3 and 3.5% mortgages. I mean,
well, this is the question right now, though, as well. So, I mean, that's where we're being priced off those mortgages. I mean, you can get, if you want to give the Australian government money for 3 years, you can now get 1.15 now, I think. So you can get 1.15 if you want to give the Australian government one, or you can, the banks had been lending at 1.9. It seems to be, that you would have to see that 70 basis points, 100 basis points higher over if this is where the current yields are going to stick, at least. So yeah, the Australian housing market is, if this is what we're looking at, is certainly looking at much higher mortgage rates.
Yeah, well, I just think it's dislocated right now. I think it's diluted, but we'll see. So right now, inflation is red hot, but growth is falling, and so that's given everyone the stagflation narrative, which is very bad for stocks. Typically speaking, it hasn't been too bad so far. It's caused a stall rather than a fall. But if it were to persist, it is a very difficult environment for stocks, and that would be quite challenging. Deflationary environments are fantastic for stocks, basically, especially growth, which is what we've seen for the last, almost the entire last cycle, but particularly through the pandemic, and anything that's kind of growth and long duration, like can go gangbusters, and I'm talking FANGs and the like there. So it is a critical question, absolutely, in terms of how you're going to deploy your equity funds, using which factors to catch the upside, the most upside, or avoid the most downside in the equity market. We're still pretty confident that in the end, deflation will win out over the next 12 months. But no doubt about it, for the time being, the equity market's gone a bit balmy over inflation. So, at this stage, we're very happy to pick up a lot of what the markets are selling. We're accumulating long bonds in Australia, and as the Aussie dollar rises on the back of that, we're picking off foreign assets as well. So, over the longer race, we think that the deflation call is the right one.
Very good.
Equities as well.
Was there anything else we wanted to cover in the investment outlook? I'm conscious of time here.
No, I think that's probably enough, I think.
Yep, that's all the questions we had. Thank you both for joining me, guys. Much appreciated.
Thanks, Jayden.
No worries. So our viewer question of the week is: will the earnings boom that we've shown here today last? So thanks again for all of you who have tuned in and watched this episode live, and to all of those of you who've asked questions. As always, we do welcome your feedback on this show and any suggestions that you have for topics. Finally, please don't forget to head on over and check out content from us at nucleuswealth.com/content. You can see our social media there. So follow us on those if you want to stay updated on that said content, and you can follow us on all major or minor podcast platforms. Once again, thanks for tuning in, and thanks to the hosts. We'll catch you at the next one.